Hello, welcome to this channel where we simplify accounting and finance together. And today we are going to be looking at the T account. And a T account is basically a graphical representation of an account. Okay. First, let us look at the pathway towards financial reporting. And it starts by the recording of an individual financial transaction as it happens. Okay, so when a certain transaction occurs, a journal entry is passed, and this entry is recorded in the general journal. Okay, and the general journal posts to the general ledger, which keeps this transaction and classifies them per account, per the account they relate to. You will come to know every business maintains something we refer to as chart of account, which is basically a list of accounts that this business uses to record their financial transactions. And these accounts are usually depends on the operations of that business. Okay, if a business knows, okay, from revenue, we have sales. We usually buy and sell, so there is sales account. If we usually earn interest from the money we have, then we have interest income, which is also under revenue. If it is expenses, we know we have rent. Okay, if you are paying rent, then we know there's a rent expense account. If we have employees, then we know we will have a payroll expense account. So all these accounts, they are classified to whether are they an asset account, are they an expense account, are they a revenue account, are they a liability or equity. Okay, so a business usually has this chart of accounts, and it is all depends on the operations of that business. Okay, so the general ledger then will have these transactions, and you will be able to see from it, okay, these transactions relate to movement in cash, this is revenue, this is sales, this is whichever. Okay, and from it then you're able to pull a trial balance at a specific time. Okay, so you're saying at the end of the month you're able to come up with your trial balance, and also then you'll be able to come up with your balance sheet at the end of a specific period. And from these two and the balance sheet, you'll be able to now to even come up with the information for the other financial statement. Okay, so basically that is an overview of the journey to financial reporting. Okay, how we come up with the whole set of financial statement, where that information begins to the coming up of that the whole set of financial statements. Okay, so let's go back to the T account. The T account, as the letter T says, is T, and usually this is a graphical representation of a specific account, and it shows how transactions happen as they occur and how they are recorded as they occur. So the debit is usually on the left side and the credits on the right side, and you have to indicate which specific account this account is. Okay, if it is a cash account, you just write the cash account. Remember, before the accounting software came, accounting used to be written on paper, so these things needed to be clear and well written for someone to be able to flow and see how transactions are happening. Okay, so right now this whole process from the journal entry to the general journal to the general ledger and the trial balance, all this is automated, so you won't see as it happened, because it automatically, when you pass a journal entry, most of the system, they are linked to passing to the general journal and to recording that in the general ledger, because the system already has been linked to the specific chart of accounts. Okay, so let us look at an example so you're able to see and understand what usually happens behind what you can see in the back end of these softwares. Okay, so I open a business. for buying and selling cups. And I, as the owner, I invest Kenyan shillings 50,000 in cash. Okay, first let us look at that transaction. And always the first question you ask yourself is, which accounts are being affected? That is usually the first question you ask yourself every time. Okay, and I, from the first one, I, the owner, now I invest Kenyan shillings 50,000 in cash. The first thing you should note there is I have a cash. We should have a cash account. Okay, cash account, because we already can see there's some money that is going to be that is moving to the business cash account. Okay, don't forget debit is usually on the left and credit on the right. So when recording these 50,000, what is happening to the business cash account? It is increasing, so you need to debit. Okay, so you come record the 50,000 on the debit side, because now you have money that has increased. Maybe you had 0, now you have 50,000. On the other end, what has happened? I, the owner, I've invested 50,000 in cash, so we need to show that there is an increase of equity in the business. Because remember, I said if the lender to the business is the owner, then that is what we call equity. If the lender is a third party other than the owner, then that is a liability. So in this instance, it is the owner. So this is an equity account. We can just call it capital account. Okay, and this is an increase to the account, because let's say initially this is the first transaction that you've made of investing into the business, and the business had 0 from the owner, now I myself. So this is the first this is the first investment into the business, and it's coming from 0 to 50,000. That is an increase to that account. What do you do? What do you do to recognize this increase of 50,000 to an equity account? You credit. Don't forget, every transaction there's usually a debit and a credit. Okay, and the reason why you are crediting here, don't forget this accounting equation that we expanded. Equity is usually on the left side of this equation, and when you want to increase that account, you have to credit. That is why we are crediting here. Okay, that is the first transaction. Then you go now for number 2. You buy 400 cups at 100 each. That is 40,000 in cash. What has happened to your cash? That's the first thing you should ask yourself. What is happening to your cash account? When you buy something, you give out the money and then you receive something. So your cash account is definitely reducing. So you have to come and show here in your representation in the T account that 40,000 is going to be, you need to credit 40,000. That is to decrease your cash account by 40,000, because it is leaving. Let's say, for example, you're paying with the bank, it is leaving your bank account. Okay, what is happening on the other end? When you give out these cash, you're going to receive 400 cups. Okay, so that affects your inventory account. So you have to show what else is happening, which is an increase to your inventory account. Okay, so here you are receiving 400 cups, so that is an increase to your inventory account. And when you want to recognize an increase in an inventory account, which is classified as an asset account, you debit, and you're going to be debiting here 40,000. Okay, 40,000 to show an increase of goods worth 40,000. 60,000. Okay, so here we've already done the double entry for that transaction as well. Now let's move to the transaction number 3. You sell these 400 cups at 150 each, and this is makes 60,000, and you're paid in cash. Okay, so you need first what has happened to cash. Your cash account has received 60,000. Okay, so 60,000. That's a debit because this money has been paid to you, so it is increasing. Okay, and on the other end, you what has happened? First, your inventory has gone down because you sold these cups, but you've also made a sale. Okay, now you need to have a sale account, which is basically a revenue account to record your revenue as it occurs. Okay, so you debited 60,000. A sales account is basically a revenue account. Okay, so you need to actually credit to recognize an increase in your revenue account. Okay, if you refer to the equation we expanded, you're going to realize for a revenue account, what do you do to increase it? You credit. Okay, and with that you've recorded the double entry for where you've debited cash and credited sales. Before we proceed, you need to recognize another thing. Your inventory has gone out. You need to recognize a cost of goods, which is basically an expense for the expense that has been incurred in by buying these cups, which always know you recognize expenditure once the revenue has been recognized, okay, for that specific period. So you usually recognize the expenditure once the revenue has also been recognized. Okay, so we're going to have the cost of goods account, which is basically an expense account where, don't forget, you bought these cups at the cost of 40,000. Okay, 40,000. Why are we debiting? Because this is an expense account. If you look at the equation, an expense account, you need to debit to increase that account. Okay, so here that is why we are debiting this account. And now on the other end, you're recognizing your inventory has moved out, so you come and credit this. On the other end, you come and credit 40,000 to recognize that your inventory has decreased to 40, because inventory is an asset account. An asset account, to decrease it, you credit. Okay, now let us look at the balances. Here for the cash account, you definitely have a 50 minus 40 plus 60, which is basically no, we've not finished the transaction. Actually, we had the sixth, apologies, we had another number 4, which was saying pay rent of Kenyan shillings 6,000 in cash. So you have another account of rent account. Okay, so you're paying rent of Kenyan shillings in cash. What is happening to your cash? Cash is leaving your account. Okay, so you have to decrease your account. When you want to decrease a cash account, you reduce it. To decrease it, you reduce by crediting, because it is an asset account. What is happening on the other end? You need to recognize an increase in your rent expense account. Okay, so in your rent expense account, you have to recognize this expenditure, and it is an increase of that expenditure. Okay, so you debit 6,000. This is an expense account. If you look at the equation, an expense account, you have to debit to increase it. That is why we are debiting here and crediting here. Okay. Now let us look at the balances. Okay. So here we'll have 50 minus 40, 66,000. We are going to have a 64 balance on the debit side. Okay. And then here we have a capital of 50,000. Okay. Here we have 0 because 40 minus 40 is 0. On here we have sales 60,000. Okay. Here we have cost of goods, we have 40,000. Okay. And then on the rent expense account, we have a debit of 6,000. Now let us look at the accounting equation if it is balanced. Okay. Remember, we had asset is equals to equities plus liabilities, which we expanded to be dividends plus expenses plus assets will always be equal to liabilities plus equity plus revenues. Okay, recall it's here. Okay, dividends plus expenses plus asset is equals to liabilities plus equity plus revenue. Okay, always have that in mind. Now, do we have any dividends? No. Under expenses, do we have expenses account? Yes. So we look at rent expense is one of an expense account, which we have 6,000. Okay. Is there any other expense account? This cash account is an asset account. Capital is equity. Inventory is an asset. Sales is revenue. And cost of goods is actually an expense account. So that is 40,000. Okay. And then I have mentioned we have an asset account, which is cash, which we have a total of 64,000. Okay. Is there any other asset account? No. Why? We have another asset account, but it balanced out as a 0 balance. So even if we add plus 0, and then that's all, we don't have any other asset account. Okay, let us look at the other side of the accounting equation. Do we have any liability so far? No, there is no money that we owe to a third party. Do we have equity? Yes, we have a capital account which has a balance of 50,000. Okay, and then we have a revenue account, which is a sale account of 60,000, which has a balance of 60,000. You can see we've already catered to the cash account, to the equity account, inventory. This is a revenue account. This is expense account already included, and this is a rent expense account as well. On this side, we will have 5 plus 6, that is 110,000, and then here we have 70 plus 40, that as well makes 110,000. The question is this not balanced? It is balanced. Remember, as I mentioned, the accounting equation is the principal rule that you should make sure is being followed every time. And the double entry accounting system is there to ensure that the rule still governs how we record our financial transaction, because at every specific time, what a business owns will always be equal to what a business owes. Okay, thank you for today.